I also need to record. Cool. All right, so what we are going to do is we are going to, let me just sort this one out as well, close a few documents. Actually, I don't know if you even know me, Harry, so let's start from the beginning. Huh? So my name is obviously Mandipur Rafsanjani, and I'm really thrilled to get to share this with you because I heard a lot about, you know, smart money and dumb money, and I knew that smart money is supposedly the traders who have been trading in institutions, and dumb money is supposedly the traders who trade in retail. But you know, the thing is, it's actually not true. In my 10 years of coaching now, I have met some amazing retail traders, so-called dumb money, who make more money than some fund managers. So now it has changed so much because there's so much more information available for us as well. And what I'm going to talk about today is what I've learned from working with, you know, traders like, you know, hedge fund traders. My Goldman Sachs friends have worked with some guys who have been working on prop desks in, you know, Deutsche Bank, Westpac, Hong Kong Bank, like the really, really big institutions. And the way they think and the way they trade is really interesting. It's so different to how I, as a retail trader, started trading, obviously. And I can understand how they have a very, very different approach to trading than we have. So, you know, for most traders, they start out with big dreams and goals and hopes what trading will give them. And a few years into the trading journey, the profits still seem to elude this kind of traders, and it really seems to be out of reach. And I've been working with about, I don't know, close to 1,000 traders in my life, in my coaching career now, at least, if not more. And they all have the same challenge, right? The challenge may show up in different ways, but the challenge itself is pretty much the same challenge. It is, how can I become more confident? How can I be more disciplined and do what I know to do? Meaning, how can I take my losses when my system tells me, and how can I take my profits when my system tells me, rather than getting out too late in a loss or too early when I'm in profit. And so they keep repeating the same patterns over and over again, and that is driving them crazy. And I know I have been there as well. And so when I started working with those really, really successful guys, and I had the opportunity to understand their mindset and learn more about their mindset, there's really a clear difference. If we look at the training that my institutional traders had, they have been thoroughly trained for at least 6 months before they were even allowed to place a trade. They had to earn placing a trade. And the way they were being trained was by being moved from one desk to another. So they would be on the, let's say, currency desk. Then they would be on the bond desk. They would be on the equities desk. So they had a thorough understanding of each and everything that was happening in the markets before they even started to trade. But then if you look at retail traders, and that's definitely what I did, I went to one weekend seminar and learned about patterns and options, and then I went gung-ho, and it didn't happen well, right? It didn't work out at all. And for many years I was struggling and really thinking, what is wrong with me? Why can't I make this work? And now in hindsight, I understand what it was. And yeah, pretty sad, but I figured it out eventually. So Alex from MacroOps, he's a Twitter guy, and he posted this as I was preparing for this webinar a few weeks ago. And I love what he said. He says, if you have all three things going, fundamentals, technicals, and market, so market tone, which is sentiment, then we have the possibility to find the highest probable trades. And so today I want to teach you and share with you how the 4 pillars of macro trading help technical trading to perform even better, and how that helps you to gain more certainty and more confidence. And I also want to show you, of course, the insights into how my institutional traders think about the markets, how they analyze the markets for the best profits they can have, and also insights into their mindset. Because what I found is, even though an insta trader might mainly trade, let's say, Forex, or only trade commodities or bonds, they still have a really, really strong understanding around all the other markets and how all the different markets impact each other. And when I look at retail traders, most of them don't. They just stay focused on one single thing, as if they were to learn a different market, or were to learn more what's beyond and behind a strategy or technical approach that they couldn't cope with. And it's really interesting. So economies move in cycles and are connected with the cycles of the central bank. If we understand that and connect that with our technical analysis, then what I found for my own trading, my losses became less, because now I could read the market better and know when my technical setup is going to fail. And I'm going to share with you some examples. So let's start first with, what does an institutional trader do? And it doesn't necessarily only is an FX trader, but here I want to talk about the FX traders. They follow the global macroeconomic developments, and they trade short-term interest rate differentials between different countries via currencies. So what a Forex trader essentially is an interest rate trader. And bond traders are the same. They're essentially trading Forex, which is essentially trading interests. I never understood that really, even though I studied business, and even though I studied, even though I studied economics. Macroeconomics was one of my majors, funny enough, and yet I never was able to correlate that back into trading. So what I found with my insta traders is that they make profits by following a replicable process, and this process is based on a routine through fundamentals, sentiment, intermarket, and technical analysis. And some analysis doesn't have to be repeated each day. They repeat it maybe once a month or once a year, because then the tone of what they need to know about the market is already set. And that doesn't change for the foreseeable future. Because if you look at, if we look at, let's say, a central bank raising interest rates in the attempt to temper the anticipation of an overheating economy, that doesn't happen overnight. Their monetary policy is not going to react quickly to what inflation does or what employment does. This is like a longer term process, and that's why they only need to do this work once or twice, and then they can use it over and over again for their shorter term trading setups. And so if you look at macro trading, it's really making a picture of the relationship between the different markets. And it's the studies of economic, social, political, and technical conditions. And that can be applied to any type of trading instrument. And again, when I started learning I started learning technicals, and I'm extremely visual as a trader. So anytime I heard something about macro, my head was exploding, and my brain just literally went blank. And so I thought, I can't do macro. I just don't have what it takes. I'm not smart enough. And so I was actually putting blockages into my own way. And that was the main reason why I stayed with technical trading, because I thought I'm just not smart enough to understand macro, which was at the time a real big reflection of my self-image. But I didn't see it as that. I just thought that's normal. I never questioned it until I was talking with someone who questioned me about it. And then I realized that I need to do some work, remove the blockages, and then having removed the blockages, suddenly macro became clear. It was really interesting. It's like someone has removed the fog on my windscreen. So what we know and as traders work with is that our entire economy is based on credit growth. If there is no credit growth, there is no economic growth. And that's why in 2009, the US started with quantitative easing, and in 2014, I think it was, in 2014, Europe added quantitative easing to their monetary policy. And the quantitative easing, which is printing money, increasing the money supply, then changed the whole set up in terms of theory. And that's when macro trading became really interesting, because all the old correlations, they didn't work as well anymore. And now it was about understanding what does that mean for the old correlations. And I'll show you later on what I mean with correlations. So the first step, what my insta traders do, is really understanding, identifying where an economy is in the economic cycle. So if they want to trade the, let's say, Aussie USD, they want to know where the Aussie dollar economy is compared to the US economy. And if you look at the market, okay, let me just show you some charts here. If you look at the Aussie dollar, right? Take all the crap off. And we look at this period here. From 2009 up. That was the time when in Australia was the highest interest rates in the world. No, actually not the highest in the world, the highest after New Zealand in the first world countries. So I'm not talking about countries like Turkey and so on, because they had like 7% interest rates, but that was a reflection of the risk and not a reflection of the economy. And so if you understand this, what happened, US reduced the interest rates and Aussie was really high in interest rates, then you understand carry trades, and you understand then that this is a nice bullish setup, and you could have written it all the way up. Did I? No, because I didn't understand macroeconomics at the time, which, well, I really missed out on some amazing trades. However, I got this move to the downside, and I'll tell you in a minute how I did that. So at the beginning, when I started trading, I really thought all I need is TA. And it's true, right? It is sufficient. And I've seen some traders that do amazing work in just trading technical analysis. What I found, though, is that as soon as I started adding macro analysis to my trading, that my results improved, simply because my losing trades reduced. And again, I'll show you in a minute on the Aussie dollar how that played out in my trades. And if you look, for example, at all the traders who have been calling a bear market for the last 10 years, when the US market just went like crazy. Just change the templates here again. So look at that, the last 10 years, really, there was stuff going on, right? And here we now have a double top happening. But that could have been a nice long trade for, what, 8 years? And that was really driven by quantitative easing. And that's then when I realized how important it is to understand how macro analysis can help with your technical analysis. And then if they are hand in hand, if they're showing the same picture, then you have a much higher probability in your trading. And so what I found is when traders talk about lack of confidence, there is a little bit of lack of competence in it as well. And so why is macro trading so important? Macro trading is important because if you look at the what the institutional traders do, who are the markets? Who are the guys who move the markets? It's the hedge fund traders, it's the bank traders, it's the prop traders, it's the bond dealers. They all talk about how to trade, how to move the market in really big numbers. So us small traders, we can't move the market. And there are 4 pillars that they build their strategy on. It's the fundamental analysis, the sentiment analysis, the intermarket analysis, and the technical analysis. And so I found this one as well on Twitter as I was preparing. One key question I still have is what changed when you went from being a losing trader to a consistently winning one? What was your edge? Where was your edge coming from? That's from Hedge Fund Market Wizards. Can you provide some examples to illustrate how you trade markets? I learned to pay attention to how markets move relative to each other. I became a correlation trader, the same thing I still do today. And so you can see really that all the big traders, in some way, shape, or form, they use correlation. They use those 4 pillars. Let me show you how that works, okay? Fundamental analysis is everything that is monetary policy, for example. Sentiment analysis is how what is going on in the country in terms of how much what is the mood of the country. So you could see in the UK with Brexit that influenced the pound, right? Could see in what did we have in the US, how Trump started influencing the mood of the country. So those geopolitical risks that are being taken into consideration. Then intermarket analysis means where, and I give more examples later on, where we look at how milk, for example, the price of milk is related with the New Zealand dollar. Who would have thought? Where the price of copper is related with equity markets, where interest rates are related with equity markets. And then we look at that, what does it mean for the individual country, and then compare that to each countries. So again, if we look at, let's say here, Aussie dollar again, right? If we look at how the Aussie dollar is related with the gold market, for example, or how the Aussie dollar is related with iron ore, compared to what the US dollar is doing, that gives us a really good insights in the probabilities of how we want to trade that market, and then compare that with technical analysis. I use the Aussie dollar because we had this beautiful double bottom setting up here, and that was in line with the sentiment analysis, because what happened when all the currencies that were down started going up, we had the midterm elections. So you can see something that's also interesting. Link on the DAX. So the DAX has been coming down, but gold has been coming down as well. Where's gold? Gold, XAU. I can't see it now. Sugar. Grab gold from here then, huh? I think it was on my other account that I had gold up. Got too many accounts. There we go. So gold just got absolutely killed. And if we know the correlation that the Aussie dollar runs in line with gold, and then we look at what happened with the Aussie dollar went up as gold was coming down, then we want to know why, right? And one of the main reasons was because of the US dollar index. Let's put that one up. And the US dollar index was driven by the midterm elections. That's when it started to run up. So if we start understanding those correlations, because I saw a few traders that said, oh, gold has to come up because the equities markets are coming down, and they got absolutely killed in the market in gold dropping. If they had understood that gold is not only in what's it called, a flight to safety currency, it is actually also in sorry, hay fever here. It's hay fever season in Australia. That's better. So gold is also impacted by the US dollar index. then they most probably wouldn't have taken that technical long setup in gold. And so that's why I'm saying, knowing and understanding more about macro analysis now, that's when my trading really changed. All right. So if we look at step one, right? Fundamental analysis. In fundamental analysis, we look at where's the country at in its economic cycle. And I don't want to go into detail because that's not the purpose. It's just really the purpose is to show you an overview and what they're looking at. The interpretation of how they're looking at the market is something completely different. It takes like, a week to teach you the details, a weekend to teach you the details, and then a lifetime of applying it. Really, that's what it is like. So leading indicators, we want to look at the announcements for supply and demand of durable goods, the purchasing manager indexes, the consumer confidence. They are leading indicators that give us an idea into what is most probably going to happen with the interest rates. And interest rates are everything that drives the economy, that drives the country, that drives everything, that drives our lives, right, as individuals. And when I was asking Matt and Tony, so they're TechFX traders and Alpha Hub on Twitter, I said, which is the first market that you're looking at? They both said the bond market, because bonds, interest rates, they're driving everything. And look at our own personal lives, right? So in Australia, interest rates are historically low. And so, you know, the Aussie dollar came down hard, right? When that started to shift. And that was a lot of carry trade unwind as well. So if you understand carry trade, then we can start with volition, and we can use our technical analysis to help us to time our trading, our entry and our exits, and to also have confidence in our system because we have competence, right? We have more competence. So these impact the monetary policy. And so, sorry, what I meant to say about the Australian market is that recently the banks, they increased the interest rates for home loans because they're also funding money from the US. And because they're funding the money that they lend out to us individuals from the US, the money in the US became more expensive. So because America increased the interest rates, that has an impact on me, little me sitting here in Elwood in my little flat, because now I have higher expenses because of my home loan, my credit cards, everything, right? Then, of course, then we look at the monetary policy. Are they bullish, bearish, or neutral? And for that, they read every month the monetary policy statements. They read the policy statements for Europe, for Australia, for New Zealand, and they know how to interpret them. I don't really know how to interpret. I don't need to know because I have those excellent guys, those Goldman Sachs guys. I mean, Tony and Matt have been trading for Goldman Sachs for 8 years. There wasn't like a one-hit wonder. They performed consistently because I can tell you it's cutthroat. The moment you stop performing, you're out. That's how quick it goes. And they have consistently performed and still are trading their own accounts. So those guys know how to read the markets. I also love Chris Weston, who, thank God, now is at Pepperstone. I'm really excited about that. And Chris is one of the thought leaders here in Australia. He is so good. He sits in front of the Bloomberg terminal all week, all day. I mean, he has access to information that I don't have access to. So I only need to know the overview of how macro works, the detail, and the interpretations I get from those guys. I ask them. So they also look at which are the trends and key indicators. So again, what's the interest rates, the price of money? What does inflation do? What does gross domestic products do? Retail sales. That is for them also key indicators that they look at in order to analyze should they go long or short the Aussie dollar, Aussie yen, euro yen, whatever market they are trading. Canadian dollar, as you Canadian guys know, is correlated with gold, right? So that was a massive trade in the last few days. Technical analysis showed on the CAD. Let's grab the CAD. blank. Voila. That. So look at the cat going up so beautifully, and gold just collapsing. So the US dollar cat, I must say, going up beautifully, and oil collapsing, not gold. What am I saying here? So they were so beautifully correlated. And you could argue that there was a technical entry, depends on how everyone works, a technical entry here when it went through this previous high. I know other traders, they started going long further down here. And that was based on what they saw happening in gold. Now, if you want to understand an economic cycle, it's really, really simple. We don't want to overcomplicate it. The cycles are like this, right? And now look at, let's say, where the US is in this cycle, and let's say where Europe is in this cycle. Or I don't like to say Europe because, I'm German, as you guys know, and I come from a time when it wasn't Europe, it was Germany and France, and we were like all individuals, and we are so different, right? It's like saying the Canadians are the same like the Americans because they speak a similar language. And in Europe, we don't even speak the same language. I grew up at the French border, so German and French is very different, as you guys know. So the country in Germany has a very different economic cycle than Turkey has. So I don't want to say Europe, I want to say the country in Europe that we want to trade against. And if we know that, for example, the US is at the beginning of the economic cycle, and just make it up now, Germany is at the end of the economic cycle or the other way around, then we can also become much more we have much more certainty about what is going to happen with our currency pairs, right? If we trade euro against US, where in the short term maybe we have some reaction, but in the long term the direction is still just one way. Again, like we have in the Aussie dollar. Yeah, it's just easy going downhill since 2011. What happened in 2011 was that our currency was so strong that our tourist industry was suffering badly. Every Aussie, they went overseas, and because it was so cheap, and not many people came to Australia on a holiday because it was too expensive, and the tourist industry was ailing, and so there wasn't the RBA interfered a little here with the interest rates and the monetary policy as well. So if we look at global macro, it's all these areas: economic, social, political, technological conditions of the country. Money is a driving force. Now, interest rates, which are pretty much a graphical illustration of money, are graphically illustrated on yield curves. So a yield curve shows the short-term, medium, and long-term interest rates. And when I saw yield curves, or traders talking about yield curves on Twitter, it was like, whoa, blowing my mind. And recently they were talking about if the long end hits 3%, then the equity markets go to hell. And I had no clue what they were talking about. And some said they're going to hell, and others said, no, they're not going to hell because employment is still strong in America, and so on. I had no clue. And then I realized that it was actually not that difficult to understand. And that's why I'm sharing this with you, because I want you to have just another tool in your toolbox to look at the markets. If you look at interests and you read the monetary policy statement, there is the talk of dovish and hawkish. And I never could remember what dovish and hawkish means. Now, it's so simple. And that makes macro also difficult because they use all those words like dovish, hawkish, yield curve, long end, short end. Why can't they just call things for what they are and make our life easier? And I was asking a friend of mine who was studying at the London School of Business, which is really, really prestigious, an amazing trader. And he laughed at me. He said, we pay a lot of money for our education. So, we don't want everyone to understand what we are doing here. It's a little bit like lawyers as well. They need to have a reason why they can charge so much money. So if we look at dovish, that means that they want to keep the interest rates low because doves, they fly low. If you look at hawkish, they want to increase the interest rates because hawks, they fly high. Yeah, and it's really as simplified. We don't need to know more. We don't need to be the experts. Now we can look at the experts and see how they interpret the monetary policy statements. Or if you fancy that, learn to read the statements yourself. I find it incredibly boring. Not interested. And so if you read the yield curve, there's a short end and there's a long end. And what they were talking about a few months ago was the long end going to 3%. And I'll show you in a minute what that means. Then there's yield curve that's a normal shape and an inverted yield curve. And then they come up with words like bull and bear flattening, bull and bear steepening. Utterly confusing. And yet so powerful once you understand it. Bullish on interest rates, where interest rates fall, and bearish on interest rates, where interest rates rise. And we know usually that bullish means something goes up and bearish means something goes down. Not so in the yield curve. All right, so here we have a yield curve, right? And this is the short end here. The short end is called short end because it's like the next year or two. So it's 2-year interest rates. The long end is called the long end because it could be in the next 10 years, 100 years. What is it? It means that you get your money back in the next 2 years. So if you look at the short end and what the bond market really is they're lending money. So if I buy government bonds, I lend money to the government. And on the short end, in the near-term future, the interest rates that I get is much lower than if I lend them money for 10 years. Why? Because the risk that I get my money back in 10 years is higher in a normal environment. However, if you look at someone like Greece or Argentina, who recently issued a 100-year bond, for them, they had to issue the bond because they ran out of money. And that's why for the shorter term rates, the risk is higher that they get their money back. So the short end is higher in terms of interest rates than the long end. That's all it means. It's as simple as that. So if I have a friend, so if I want to lend money to Harry, and Harry I know has a lot of money, he's investing into new projects, like we built the train projects here in Melbourne. And then if I would lend him money for 10 years, then I would get a higher interest rates than if I lent him money for 2 years. But if I lend money to someone else, Mr. X, and Mr. X is running out of money and I don't know if I get my money back, then on the shorter term, I get more money. So this is what the shark does, right? The loan sharks do. That's how simple it is. Now, I asked Chris to send me this chart of the 2-year against the 10-year since 2008 for Australia. Now, I have no clue how to read this, and I don't need to. Again, if I need to ask, then I ask the boys, ask Chris or Tony, Matt, Alba, who's Steve Deacon, who used to trade for Paul Tudor Jones. We have all those amazing people at our fingertips on Twitter who are so willing to help. But we need to have the basic knowledge to understand what the answers actually are. And if you look here, 2008, the interest rates already indicated that trouble is blooming, right? That something is up. And then when the market started to recover, it also showed the market's going to recover. This is all that we need to know. So you can see the leading indicator to help us with our technical setups. And then if you look at our technical setups in 2000 and where's the Aussie market? Australia. If you look at the Aussie market here we go. In 2008, there was a beautiful bearish engulfing pattern on the monthly chart. There was a short entry for me. Knowing that there's a short entry, understanding this chart, understanding what happened in the markets in terms of fundamentally sentiment, right? So fear, or the foreclosures in America, intermarket analysis, how, because what happened in America, we all got affected by it as well. Then we can go to our technical setup and we have so much more certainty about our trade. And the certainty comes from competence and not from how we want to feel and think how we have to feel. Yeah, and that is where the big difference lies. This is why a lot of institute traders are so much more certain, because they have a lot more knowledge at their fingertips. Cool. So now let's look at bull, bear, flattening, bull, bear, steepening. Whoever came up with those words. What it really means in a nutshell, to simplify it. When we have a normal yield curve and the central banks, they call it the CBs, increase the interest rates, then this area here goes up. If they reduce the interest rates, this goes down. Now, if the expectations in the long term, the inflation expectations and so on, so the markets like the hedge funds, the JP Morgans, the Deutsche Banks, the Goldman Sachses, the Merrill Lynches, all those big guys, if they expect in the future that the interest rates are going down, that's when this part here goes down. If they expect that interest rates are going up, this is when this area here goes up. That's all it is. Now, this is so powerful, because the factors that are influencing this curve are inflation, economic growth, interest rates, and so on. I don't want to go into detail here. It's too boring. And if we understand this, then we know how the decisions are being made on the short end or the long end. And why is that important? If we have a bull flattener, that happens that the curve flattens, so they call it the curve flattens. So you can see here it's much steeper than here, it goes flatter. Here it goes flatter as well. And here it becomes steeper. If we have a bull flattener, that is in a nutshell bullish for the economy and hence bullish for the stock market. That's all we need to know. If we have a bear flattener, it's bearish for the economy and bearish for the stock market. If we have a bull steepener, it's bullish, and we have a bear steepener, again, it's bearish. This is such powerful information for us to make decisions on the long term. So if we know that we have a bull or a bear steepener, let's say in our Aussie dollar now, and we go to the shorter time frames here, what happened in the past, right? I would be, let's say, that was double top for me, bearish engulfing on the second top. Looks like after beautiful long impulsive run to the upside. So all my requirements are being met. I go short here. And then it goes down. I'm like, yay, I'm in the money. And then we have a reversal pattern, bullish engulfing. I'm like, oh man, this is going to fail. I get out either at break even or most probably at a loss. And then look what happened the week after. Damn. I go back in short, and then what happens? That looks again like a bullish engulfing. That is a technical long signal. And so, I would be whipsawed out all the time. But knowing that the economic factors have changed and that the macro factors have changed, not only in Australia, but mostly in America, and that is impacting us, I didn't need to worry about it. So I kept my stop loss up here. I was riding this out with some sense of trepidation, indeed, that's okay. And then as soon as possible, I started connecting those dots here. So can you see how powerful this is? And now we can start riding. Now we can start riding the channel. We go short here. Maybe we keep this short, but then we put on a long position. Actually not here because we don't have this channel as yet. Let's say here. We now start getting a channel. And then we can write the channel up and down and up and down. I am not really good at channel surfing, so it's not something that I would do, but I know traders who do that really successfully. And here we have a double bottom played out beautifully. Look at this one. Double bottom, target would be about here. Look what it did, went right to target. And now I'm using my technical setups in the context of my macro. I'm not going to trade big positions on my double bottoms here because I know from a macro point of view that still needs to go down. Or maybe not. Maybe the macro environment is starting to change. Who knows? But this double bottom worked out beautifully, and my entry for this double bottom was here, this bullish engulfing candle. So we have a low here, we have a second low here, we had a bullish engulfing. So if I put on my system, don't worry about too much here. Take this one off, this one off. So you can see we have a low here in price. We have a low here in price. And we have a bullish divergence here. And then we have a bullish engulfing on this one. It broke out of this downtrending line. So now I take a long, put my stop loss down here, and let this thing ride. Goes up, open higher, low, close higher. If it had broken below this low here on that pin bar candle, I would have taken my profits, but it never did, right? Then next there was sideways, sideways, up, and then here we have a reversal pattern, and so profit was taken here. I actually, as I said, I didn't trade the Aussie dollar. That would have been a trade that I would have taken, but I was working with a trader of mine, and he saw the Aussie yen. I have the Aussie yen. Where's the Aussie yen? It must be on this one because that's where we took the Aussie yen. Here, Aussie yen. So we took this Aussie yen, and let me show you what we did here. It's the daily. So he saw this one as a pin bar, and I said, in my model of the world, this is not a pin bar because I want the pin bar to be really outside all this mess. I want the close of the candle outside of any previous price. And I said to him, but it doesn't mean that it's not going to work out. So what we are going to do is we're going to put a small position on, we point like 0.2 on. And I do that with my traders because when we put on like real time, you know, that was like a $15 stop loss, was nothing, right? When we put on those real time trades, that has so much power for them. And that gives certainty. And also because I share the risk with them, that helps them also to find more certainty in their trading setup. And so you see that thing worked out really well. Stayed in this trade until up here, and then got out up here because you can see it took out the low. And that was a beautiful trade. And also this double bottom was being completed, right? Voila. There you go. So it doesn't mean that I wouldn't trade purely technical on the short-term trades, but I keep the long-term macro in mind. And this is the power of understanding the yield curve. Don't need to know why that happens. All we need to know is that happens. The timing of when to go long or when to go short is really TA, because I've seen a few months, like I think since August, some of the really, really great traders talking about the market has to come down because of bull, bear, flattener, steepener. And the entry was really only in October. Now let's look at this. How can we apply that for making our trading decisions easier? How can we make money from what we have learned today? If the Fed is hawkish, And you guys know now what hawkish means. Hawks fly high. They want to increase the interest rates, which they did. And we have strong economic data. That is good for the US dollar. Let's look at what the US dollar did. US dollar. Here we go. That's good for the US dollar, right? Then we want to go long US dollars and short another currency. But which currency we are going to go short depends on the strength of that country. So that country's economy has to be weaker in comparison to the US market. So if I trade Aussie, New Zealand, then I want to know which market is weaker compared to each other. And I don't really care about the US dollar. But I also know that the US dollar impacts my Aussie dollar and the New Zealand dollar. And so when I have all these pieces of the puzzle together, my decision-making process is a little longer, yes, but there is so much more competence and so much more certainty. When the Fed is hawkish, but the data is weak, then we want to look at volatility trades and defense stocks. And Chris is going to run a volatility webinar next Tuesday. And I'm going to, you can email me if you're not on Twitter, but I'm going to put the link on Twitter because it is so important and no one really teaches that. And I'm so excited that Chris teaches that. And if you look at the bull flattener, you can see bonds and gold and equities and companies when we are in this area here. So what happens now is that we can start with trading with so much more volition because we look at the big picture, what is happening, and then we drill down into the small picture in terms of technical analysis, and we understand where and when to trade which market best. We could go even into which stocks to buy at which time. Again, we have a really big picture here. But then we want to drill into the individual company, if the individual company is a good company. So let's say technology stocks are great stocks to trade in this area here, between the early and the middle bull. It doesn't mean that the company is doing well. We still need to make sure that the company's technicals and the company's benchmarks are being achieved and that they're doing well. Or we can simply trade the technology index, the XTI. What I did in 2007, so Jim Rogers, he was talking about how he thinks the market is going to go to shit, frankly. That's what he said. And I didn't understand any of that. But we had the XTF here in Australia, and I was trading the XTF short one contract, and it went really well, didn't it? Yeah. There you go. So we can trade market segments. Then they look at sentiment analysis. We can look at sentiment analysis in the short-term context, so what happened overnight, but also in the longer-term context in terms of, what's going to happen in the next few years. Overnight means is the market risk on or risk off. So I wake up in the morning at 6 o'clock in Australia and I look at what did the Australian market do. What is going to happen in the Aussie market as a result of that? And I know that the Aussie market often likes to do the opposite. So if the US dollar was down, the Aussie market likes to rally on the back of it and the other way around. How do I know? I have experienced it because I thought I'm going to be smart. And if the US dollar is down, the Aussie dollar has to be down. The Aussie market has to be down. But it doesn't work this way because we trade mostly of the futures, in CFDs we trade mostly of the futures markets. That is already priced in. And so even though the cash market might gap down, but where I can place my trades on my platform, on my CFD platform here, that is actually already priced in. And that's why I can't just necessarily say I follow exactly what happened in the US market. Where is our Aussie market? Never mind. So when we look at which assets does money flow into, then that gives us an inverse feedback into which stocks to buy at which time and what is most likely going to happen here. So that gives us an idea into what's happening in our monetary policy, what's happening in our day-to-day life even. Which currencies show strength versus weakness. Then there's the sentiment indicator, which I love. And I have a really good friend here, Devin Clark. He's an amazing trader. And he has his own brokerage called Trade Direct 365. No, Trade Direct 360, I think. Never mind, Trade Direct something. And so he solely trades off sentiment indicators. He says, if too many traders in the euro are short, then there is not enough traders left to sell, and the market, the euro, has to go up. He's adding a few more information into the context, not solely sentiment, but that's one of his main indicators. And the other way around, so if the market if too many traders are long the euro, there's not enough traders left to buy, and then the euro has to roll over and go down. COT reports, so commitment of traders reports, I personally don't like them much. They are lagging reports. We only get them at the end of the week, I believe. But I know traders who do tremendous work, tremendous trading based on COT reports. And then FX options positions. I love them because I see, so I'm in a Skype group with some hedge fund guys, and one day one of our boys was posting early in the morning, something weird happened overnight in the options positions. And we're like, what do you mean? He says, I have no clue. I just see something doesn't pan out. Something is irregular here. And then indeed on that day, some big announcements came. It shows that the options market or the stock market already knows in advance if something big is happening. And that was reflected in the options market. So even though he didn't know what is going to happen, knowing that something is going to happen, he was well prepared. And he looked at his technical setups, and his technical setups showed really how the market is going to react on that day, that something is going to happen. Now, on the flip side, what I like to share with you guys, as you know, I love trading the euro, the DAX. Where is Mr. DAX? Here, DAX. So how I fell in love with trading macro was in 2014. In 2014, Chris Weston was running a meetup group for FX Trade. And in that meetup group, Chris was talking about, and that was about here, this candle. And that, I think it was even August. So that meetup group, he was talking about if Draghi is going to announce QE, the DAX is going to go up to 12,500. And the DAX was 9,500 at the time. And I'm like, oh, wow, that's interesting. So I went long the DAX for a little, made money on it. And then I had this technical setup. I was pretty sure, I did know the futures at the time, as you can imagine. I was pretty sure that's a beautiful double top setting up. Went short, and QE was announced, and then this thing rallied, and I got whipsawed out badly. But, I thought I'm smarter than ordinary people. I remember what Chris said, and I went long when this high was being taken out, and lo and behold, it went to 12,000. And that's when I fell in love with macro, because I thought, wow, there is so much more to trading than technical analysis. That was a beautiful setup for me. How could I have known that this is going to fail? Easy, because QE was announced. That's all it took. I needed to listen to an announcement. So how powerful is that? And that's when I started looking at macro. But again, as I mentioned at the beginning, I never thought that I'm smart enough. And the moment I read about economic cycles and yield curves, my brain just went blank. And until, as I said, someone challenged me on it, and I got coaching on what's going on in my brain and my self-image. I removed the blocks, and now I look at macro and it's all clear to me. And that's why I thought I need to share this with you guys, because if the big guys, like the macro guys, talk about macro, it just doesn't make sense. It's too complicated for me. because they don't understand that I need the simple basics to start off with. And this is kind of like macro for dummies almost. All right, so intermarket analysis, that's what they then do. And this is the normal behavior, right? They say if US dollar, yen, and stocks go up, gold and bonds goes down. If stocks go down, so that's risk off, gold and bonds go up. However, this is just what normally happens. And now this is why it's so important to know what is happening here in fundamental, sentimental, intermarket, and technical analysis, because this correlation doesn't work at the moment. Anyone knows that the markets have been down and gold has been down, as I showed before. And the reason for that is because we have some geopolitical situations that impact the behavior of the US dollar index and the behavior of all the other markets. Understanding that, you now can again be safe from making quick decisions and thinking this is how it has to be. Yes, this is how it works in a normal environment. We don't have a normal environment at the moment. We have an environment that is driven by Trump, by midterm elections, by Brexit, by a lot of geopolitical influences. And so again, then they look at intermarket correlations. If copper goes up, Aussie dollar goes down. Gold goes up, Aussie dollar goes up. That didn't work, did it? Aussie dollar is up, but gold is down. Why is Aussie dollar up? We want to know that. And then we get an indication of why this correlation didn't work out. Usually when the euro is up, DAX goes down. Why? Because Germany is an export country. And if goods become too expensive, sales go down. Now we know what happened. DAX went down and euro went down. So the correlation doesn't work. And this is where it becomes powerful, because most traders, they say, oh, this is what should happen. And then something else happens. Something else from one of these elements. And we know what's going to happen. And hence, we are not going to go long gold. We are going to go short gold because we know that something else happened that influenced the price of the gold market. We don't go long euro because you know what happened. Merkel resigned. Sorry, Merkel didn't resign. Merkel said that she's not going to go for a second election in the next term, so 2021, I believe. And so that's bad for the euro. And there was a quick reaction for the euro to come down hard, plus US dollar index going up. And that's why this correlation didn't work. That's so powerful, isn't it? Do you guys get it? Does it make sense? I hope you do. I hope it's interesting. I'd love for you to maybe give me some feedback in the chat, or you can also, because just us, you can also unmute yourself and talk to me. Cool. All right, so, and then technical analysis. I don't need to talk to you about technical analysis, most probably. We all know technical analysis. So I use technical analysis really to manage my trade, to manage myself, and to determine when to enter and when to exit. And it's my favorite example of how do I know when I should get on the train. I know when to get on the train, onto the train when the train stops and the doors open. And I know when to get off the train when my stop is being announced and the train stops and the doors open. Why is it important that I know where my stop is being announced? Because I don't want to get off the train too early and I don't want to get off the train too late. And so, as I showed before, my clear entry would be on, let's say, where was the double top? It was the Aussie dollar. So here, right, we have the double top. Bearish engulfing on the second top. My getting onto the train is close of this candle. I go short, keep my stop loss up here. Voila. My getting off the train now was when it breached that downtrending line. And also there was a double bottom setting up. So I was already prepared, and I took along on my other account. So I've got a few accounts that I trade on, some longer terms, some shorter terms. I found trading both accounts, both strategies on both accounts, on one account, totally confused me, and I would close out the wrong trades, and MT4 is really not suitable for trading several strategies onto one account. So I've got about 4 accounts on Pepperstone to trade the different ways that I want to trade. Also, it helps me to keep an eye on my metrics and to keep an eye on how I perform, which market performs best, which strategy performs best in each market. And of course, when I take my trades with my traders, I don't want that to dilute my statistics, right? Because it's not really my trades. So it's something else to consider. Okay. So in order to increase the probabilities of your trade, follow the monetary policy of the central banks, understand how it influences the yield curve, and understand how the yield curve influences the instruments that we want to trade. Know the news stories. You need to know that they're happening. You don't need to know exactly what is happening. I don't know the ins and outs of Brexit. Bores me to death, not interested, but I know it is happening, and I am always on top of something will impact this decision. So when Theresa May made some announcements that really influenced and impacted the pound, right? Be prepared for the news announcements, the longer term ones, as well as the shorter term ones. And understand intermarket correlations. So intermarket correlations, how is milk correlated with the New Zealand dollars, resources and bonds, oil and CAD, Nikkei and yen and equities. That's just a small selection of all the intermarket correlations. And, you know, when you then put them all into a circle, how they each influence each other as well, indirectly. And that's when it becomes so powerful. And it's really simple. It's not that complicated. You only need to do it once a month maybe, and then you can use it for the rest of your trading for the rest of the month. So this is what you have learned today, how institutional traders analyze the markets to increase their probabilities of success, how they gain competence. Also, what I want to add in terms of the difference in mindset with institutional traders. When they start out, and this is something that I observed by talking to so many traders, and I really have to thank people like, Chris Browning, who is an amazing trader, London School of Economics, trained, and he got me in touch with Tony Sycamore, who I then was able to have endless conversations about their trading and their mindset, who got me in touch with Matt Starkey, who introduced me to Steve Deacon, who traded for Paul Tudor Jones, who's Alba on Twitter, and Linda Rushke enormously when I met her at the ATAA, and she's so generous, this woman, like she's amazing, right? Those traders, and to understand where they came from, except Linda had a completely different start in her trading career. But those guys, so institutional guys, they start in an environment of certainty, in an environment of confidence, because they are being trained by traders who already know what they're doing. Like the guys that Matt and Tony trained with, it's just amazing. Guys who got bonuses so big that they went down to the Ferrari dealership and bought a Ferrari in cash. It's just crazy. Amazing traders. And so they didn't have to deal with the stuff that we retail traders have to deal with, that we are being stopped by. And they, I sit alone at home here with myself, my thoughts and my fears. They didn't have that. They didn't have time for thoughts and fears because they were surrounded by grandiosity and results and amazement. So that's why it is so useful to understand how they think and how they feel, because they might be not so confident in other areas of their life. Like I always say, you can give me any horse, I can tame it, right? I might fall off, but it's okay. I know how to fall because I went to judo, and in judo, the first year you just fall You just learn falling over. I know how to fall and not hurt myself. You can put me on any mountain and I know how to ski downhill. Maybe not very elegantly, but I know how to get down the mountain safely because I trained as a ski instructor. So I know those things. And these guys are the same in their trading. Now, if I were to put Matt on a horse, I don't know if he rides or not, but if I were to put him on a horse and he is not a rider, would he be as confident as I am? Most probably not. I know Tony is a surfy boy, so you can put him like he's an amazing surfer, right? And paddleboarder. He has the same amount of confidence in surfing, but if I would put him on skis, he doesn't ski as far as I know, would he be as confident? And that's the same for us traders. They don't have anything that is magical. We all have areas in our life where we are so confident about ourselves. And now we need to put that into the context of trading. So what I did at the beginning when I had my fears and my stuff coming up, apart from I was extremely neurotic, I have to admit, and I had to do a lot of work on myself, and I'm so glad I did. Because I can tell you the relief when you stop repeating the same old stupid patterns over and over again. Oh man, it's priceless. It's so good. And so I'm glad that I went through the pain and faced my shame and faced my vulnerabilities, and I slayed my demons. And it's like, bring it on, you freaking stupid demon, and I cut your head off, and with your demon head under my arm, I'm going to conquer the world of trading. I'm going to live my dreams. I'm so committed to finding a way, and I did, right? So I'm grateful for that. Sorry, I went on a rant. I can't remember what I was meant to say, but I hope you got the gist of it. Yeah. So how can you learn how to be a winner as well? Add these steps to your existing strategy. It will bring you forward. It will move you forward in your dreams and in your goals. And on that note, every successful trader has a dark past, and every losing trader has a bright future. This is what I always say. This is what I believe in every single trader who I'm working with. No matter where you're at, no matter where you come from, no matter what your circumstances, no matter what your social background, what your background in terms of education, it does not matter. You can find a way. And Linda Rushke said so as well. She says when she was on the trading floor, she saw that education had nothing to do with success. And it was simply learning the process. And there were surf bumps being extremely successful in the pit. So it didn't matter. They didn't have any normal, or no, normal is the wrong word, but any education like going to university. So it doesn't matter what your background is. You can find a way. And also what Linda said, I quote her a lot because, again, she's so amazing. She's having a new book coming out. You need to get her new book. It's war. So not war in terms of WAR, it's war in terms of amazing. So her new book is, let me just see what she said. It's, I put it here because I love it so much. So yeah, she said formal education didn't really seem to have much to do with a person's skill as a trader. That was her observation in the pits. And this is also my observation as well. It doesn't matter where you come from. This is her new book. Go to her website, which is lindarushke.net. And you can register to, because she's self-publishing as well. And if you want to know about Matt's story, this is his story. It's on my website. You can download his story. It's in the last Your Trading Edge magazine where it was published. Amazing story that Matt has. And so there is another quote that I wanted to show you from Linda. Here, I really value the fact that I've learned to trade as a craft. It's a craft that we are practicing, that we are learning, such as piano playing, such as learning sports, right? Becoming the best in our sports, going to school and learning another language. Perfection is elusive indeed. But it's consistency. Consistency is achievable. Consistency does not mean that you make money every day. Consistency means that you make enough money no matter why, no matter how, in order to live a self-reliant life that comes from your trading. That you can have down days, that you can have down months, even a down year, and you still are able to live the lifestyle. That is what the consistency is, not making money every day. Yeah, so that's more control, having to do that. And where's the other? This one here. So any approach must be simple and streamlined and balanced. Traders fail not from lack of knowledge, but from holes in their process. And this is what I see all the time. Traders come to me, they say they want to have more confidence, more competence, but they really have holes in their process. And that's why I don't only work on their mindset, I also help them to find where the gaps are in the process. And then I say, go and find someone to help you fill those gaps. Because I'm here in Australia, we have to be licensed to teach technical analysis or to teach anything that's dollar and market related, and that's why I'm not touching it, because I'm not licensed. So on that note, thank you so much, you guys, for being here with me. Do you have any questions? Is there anything, any way I can serve you with that you would like to ask me? You can either type in the chat box, or you can unmute yourself and ask me. No? Nothing? I did a good job? On that note, I want to thank you again for being here, and I hope that it's serving you, that you learned a lot. You got a different perspective, a new perspective on your trading that you could build on your repertoire, and that you go out and that you fight for your dreams, because it matters. It really matters. On that note, have a wonderful rest of the day or night, and I'll see you around.